The year is 1907, and it's one of those crisp autumn mornings that feels calm and ordinary. You wake up, get dressed, and decide to stop by your bank. Nothing dramatic. You just want to withdraw a bit of your own money. Maybe to pay a bill. Maybe to tuck some cash away. You walk up to the building you've trusted for years, and the doors are shut. Guards stand there, silent. No explanations. No reassurance. Just locked doors and uneasy faces. You press for answers, but no one tells you anything. Hours later, rumors start to spread. By the end of the day, the truth lands like a punch to the gut. You are not allowed to withdraw your money. Not tomorrow. Not next week. Not even a single dime. Your savings, your wages, your security, gone, frozen behind stone walls and paper promises. This wasn't a war. This wasn't a natural disaster. This was the Wall Street panic of 1907, and it was triggered by two men chasing a shortcut to obscene wealth. In a matter of days, interest rates exploded from an already painful 9.5% to a jaw-dropping 100%. The New York Stock Exchange nearly lost half its value. Commodity prices collapsed by more than 20%. Bankruptcies surged almost 50%. Businesses failed, workers were fired, and families who had done everything right suddenly found themselves with nothing. All because two men believed they were clever enough to bend the financial system to their will. But to understand how something so catastrophic could happen, you have to rewind a few years earlier, to a time when the American economy was already walking on thin ice. The cracks were there long before the collapse. Banks were overextended. Credit was tight. Confidence was fragile. Then, in April 1906, the ground itself betrayed the system. San Francisco was ripped apart by a massive earthquake, killing around 3,000 people and causing roughly $400 million in damages, more than $13 billion in today's money. Insurance companies, many of them British, were forced to pay out enormous claims. Gold began flowing out of the United Kingdom to cover the losses. The Bank of England panicked and raised interest rates to protect its reserves. The United States followed suit. Credit tightened even further, and what little liquidity existed began to dry up. Money became scarce. Banks ran low on cash. Businesses started failing across the country. Fear crept quietly into every corner of the financial system. And it was in this environment, fragile, strained, and unstable, that opportunity appeared to the wrong people. One of them was desperate. The other was drowning in wealth. What they shared was a complete absence of moral restraint. The first was Augustus Hines, a man forged in the brutal world of mining. He made his name in Butte, Montana, a frontier town swimming in copper and corruption. At the time, one company dominated everything: Amalgamated Copper. Backed by the immense power of Standard Oil, it swallowed competitors whole and ruled the region without mercy. For most people, Amalgamated was untouchable. For Hines, it was a target. He didn't want to destroy the monopoly out of principle. He wanted a slice of the fortune, and he was willing to steal it if he had to. In 1895, he bought the rarest mine, strategically located right next to Amalgamated's operations. Then he launched a two-front assault. In the courts, he buried Amalgamated under more than 100 lawsuits, draining time, money, and focus. Underground, his miners tunneled beneath Amalgamated's claims, broke through their shafts, and extracted over $1 million worth of high-grade copper ore. By any normal standard, this was outright theft. But Hines was a master at bending the rules. He exploited loopholes in Montana's apex laws and leaned heavily on a friendly judge, William Clancy, who ruled in his favor again and again. With Clancy's help, Hines even convinced the courts that Amalgamated itself was an illegal monopoly. For a moment, it looked like he had beaten one of the most powerful corporations in America. But endless lawsuits burn money fast. Public opinion shifted. Pressure mounted. And by 1906, Heinz was exhausted and overextended. He sold his mining interests, cut his losses, and moved east to New York, believing bigger opportunities awaited him there. That's where he met the second man, Charles W. Morse wasn't a miner. He was something far more dangerous. He was a financial predator. From an early age, Morse learned that intelligence without ethics could be extraordinarily profitable. As a teenager, he convinced his father to pay him $1,500 to manage company books, then quietly hired someone else to do the work for $500 and pocketed the rest. It wasn't about money. It was about learning how to manipulate systems. While still a student, Morse brokered massive shipments of ice from Maine to New York, where desperate city residents needed it to survive the summer heat. He filled the return trips with lumber and coal. By the time he graduated, he had already made the modern equivalent of several $1 million. By the early 1900s, Morse had consolidated nearly every ice company on the East Coast into a single behemoth. The American Ice Company, valued at $60 million, around $2 billion today. Newspapers crowned him the Ice King. Behind the scenes, his empire was built on bribery, coercion, and deception. And once he had conquered ice, he turned his attention to something bigger: banking. Morse took control of major financial institutions, including the National Bank of North America and the North Amsterdam National Bank, while gaining influence over others. Slowly, quietly, he positioned himself at the heart of New York's financial system. When he met Heinz, he saw a familiar soul, bold, reckless, and perfectly willing to break the rules. Together, they became something far more dangerous than they ever were alone. With Morse's backing, Heinz regained power. He was given influence over 6 national banks, 10 state banks, 5 trust companies, and multiple insurance firms. What had once been a lone opportunist was now half of a financial alliance that believed it could outsmart Wall Street itself. Their next scheme centered on a single stock, United Copper. The idea came from Heinz's younger brother, Otto. He believed many investors had bet against United Copper's stock price. If the brothers and Morse could buy up enough shares, they could force those short sellers to buy back at higher prices, triggering a short squeeze and generating enormous profits. To do it, they needed massive amounts of capital. They found it in the Knickerbocker Trust Company, one of the largest trust companies in the country, led by their associate Charles T. Barney. Trust companies operated with far fewer regulations than banks and held only about 5% of deposits in reserve. They were profitable, powerful, and dangerously fragile. Money poured into the scheme. But there was one fatal mistake. Heinz assumed they controlled most of the available shares. They didn't. Short sellers found other sources. The squeeze failed. On October 15, 1907, United Copper collapsed. Panic followed immediately. Over the next week, fear spread silently through New York. Depositors began withdrawing funds. What started as a trickle became a flood. On October 22, crowds gathered outside Knickerbocker Trust, demanding their money. By midday, $8 million had been withdrawn. By afternoon, the doors were shut. Knickerbocker wouldn't reopen for months. Confidence evaporated. If one major trust company could fall overnight, why not the others? Banks pulled their money from Wall Street. Lending stopped. Interest rates soared. At times, no one would lend at any price. Businesses couldn't pay workers. Companies failed. The stock market lost nearly half its value in weeks. Unemployment tripled. America was staring into the abyss. There was no central bank. No safety net. One man stood between the country and total collapse: J.P. Morgan. Morgan summoned the most powerful financiers in the nation to his private library. He locked the doors. No one left until a solution was reached. By morning, millions had been pledged to stabilize banks, prop up the stock market, and keep New York City solvent. Slowly, confidence returned. But the damage was done. Heinz was ruined. He drank himself to death by 1914. Otto vanished into obscurity. Morse went to prison for banking violations, where he befriended a fellow inmate named Charles Ponzi. History would remember that name. The Panic of 1907 reshaped American finance. It led directly to the creation of the Federal Reserve in 1913. More than a century later, the echoes of that crisis would reappear in 2008, proving that financial history doesn't repeat itself, but it does rhyme. Unchecked ambition, fragile systems, and blind trust remain a dangerous combination. And when they collide, it's never just the schemers who pay the price, it's everyone.